The Nasdaq right now is doing a phenomenal job at psyching everyone out. We had a huge drop on Friday, followed by a gap up that followed through on Monday, only to have a huge fake out today where sellers stepped in, pushed price lower, and immediately reversed from those lows back to where we are trading currently. The Nasdaq is back in the green, believe it or not, and we went from very red today to basically break even in just a matter of a few hours. Just take a look at the intraday 15-minute chart. We shot lower, especially on the stock market open right here, only to reverse higher. And with Powell speaking, we saw that even follow through to the upside further. And in regards to Powell speaking earlier, he says that slowdown in US hiring suggests the economy still needs rate cuts. And of course, the market loves the prospect of rate cuts, which I think is arguably part of the reason why the stock market has remained so strong despite some cooling jobs numbers. And we know the Fed focuses on two main things for the American people. They focus on jobs data and they focus on inflation. They want to keep both of these things at bay. And so Powell mentioned in his speech today that there is more of an equal risk to both of these things right now in the eyes of the Federal Reserve. And given that the Federal Reserve went on a rate hiking spree in recent years, raising the cost to borrow money for consumers and businesses up to 5.5%, he believes, and many economists believe, that there is room for the Fed to keep cutting interest rates to ease off on some of the pressures that may be holding back the labor market. We know that job openings in the United States have continued to trend lower in recent years. And the ADP number, which we did actually get in September, we didn't get the NFP numbers because of the government shutdown. However, we did get the ADP numbers, which Powell referenced in his speech today as showing some signs that the jobs market really could use some help. What you're looking at, by the way, is a chart showing the monthly jobs added according to the private payroll sector, or ADP numbers, which has been steadily declining here and actually went negative. And if there's one thing the Fed doesn't want to see, it's people unemployed, because unemployed people can't pay as much in taxes. They can't go out and spend money in the economy. Unemployed people are not a good thing for society at large. And then with the rise of AI in recent years, what we're seeing, at least Powell referenced in his speech today, is that a lot of junior jobs are threatened by the productivity boosts that AI generates. The less need for people, but also the efficiency for businesses, is leading things like the stock market to continue to roar higher, even though it's a tough jobs market out there for people who don't have them. But before we get too far out there in terms of demanding rate cuts now, there's another problem, which is inflation. We're looking at the consumer price index year on year, which has consistently risen from the May month here, where we went down to 2.3% year over year inflation. We bounced back up to 2.9% inflation. While we are delayed in getting this data, we are expecting to get the latest numbers here by the end of this month, despite the government shutdown. So all that stuff sounds big and smart and fancy, but let's actually turn it into trade setups. And to do that, I'm going to look at the Edgefinder's AI scanner. Many traders know that macro is important to pay attention to, the fundamentals, the economy, etc. But actually having actionable tools to help you convert that into trade setups is what the Edgefinder specializes in. We're getting bullish ratings in the Nasdaq currently, with targets back over the all-time highs here. When we take a look at the technical signal, we have a modest bullish reading here with the price action reversal here today, intraday. That looked really bullish. So I actually think Nasdaq may be headed back to the highs. Institutional activity, the latest available data has shown recent buying of the indices, specifically the Nasdaq, by institutions. We see this from the Commitment of Traders report. The crowd is also bearish, which is a bullish reading here. We could dive more into that if we wanted to, but I'm just giving you the high level views of what Edgefinder has found. Economic growth still looks bullish, with GDP numbers posting strong results, manufacturing PMIs, retail sales numbers, these things mostly suggesting a bullish environment for US stocks in regards to corporate earnings growth, which ultimately drive stock performance. The jobs market is a little bit less attractive, with employment data coming in poor as of the latest data that we've had. Unemployment rate also coming in neutral, since we are at low levels and we haven't changed in recent times. 4.2% unemployment rate. Inflation data also looks positive, with the consumer price index number not flaring up, staying relatively static here recently. PPI was actually lower than expected, and interest rates are expected to continue moving lower. So we have an environment where Nasdaq bullish setups make sense, So on Friday, I bought the dip. Specifically, during the sell-off that took place on Friday following the scary Trump tweets, I've seen this play a couple different times, and I know how this movie ends. We talked about it in recent videos. The taco trade is still alive and well. And if you're not familiar with this idea, it is basically the idea that Trump comes out swinging initially in negotiations, walks away from the deal, scares everybody, and then kind of walks back what he says. And that's exactly what we saw over the weekend. So I actually think that this dip, although brief, might already be over. Now, I want to clarify too that if we do see larger sell-offs, I think that's longer term a blessing in disguise. Short term wouldn't feel great in the portfolios, but longer term, I think the dip would actually be healthy for this market to continue its overall bull trend that we've seen in 2025. Long story short, I have a stop loss below the 50% retracement zone of support. We bounced off of this area so far. We actually doubled backed and retest here this morning, but things look pretty good for now in terms of price action. We do have a positive reversal here intraday, a very sharp reversal at that. And the P&L on the trade is looking pretty good at $7,200 so far with a stop loss below. My plan for this trade, by the way, is to look for higher lows in order to trail a stop and to manage my risk appropriately within my account. But what I hope you get from my videos is not just hypothetical macro fundamental analysis, but actual trade ideas that I am taking and why I'm taking them. And I'm not here to tell you what to do with your account, and none of this is financial advice, but my purpose with these videos is to show you real trading, real accounts, and breakdowns as to why I'm taking the trades that I'm taking so that it gets you thinking about the ones that you're taking yourself. By the way, if you want to check out the Edge Finder, we have a free version now available. And down below in the description, if you click the link, you can sign up and fill out that form to get more information about the free version as well as our 30-day trial options that we do offer on our website. Simply click the link in the description down below for more information. And if it's easier, you can just scan the QR code that you see on your screen right now. By scanning this QR code, it will take you to a form. Just fill that out, takes 2 seconds, and we will email you access to the free version of the Edge Finder and some information about what a 30-day full access trial looks like. Let's now take a look at the Top Setups simplified view of our overall findings. And what we can see is we have some bullish and bearish readings. This is essentially my watch list each day. As a macro trader, I like having this generated for me because it's looking at sentiment, technical, and economic data to generate bullish and bearish ideas for me on the charts before I even get to them. Specifically dollar CAD, Dow Jones, Nasdaq, dollar Swiss, platinum, pound Aussie, Nikkei, S&P 500, copper. These things are getting bullish ratings so far, and notably silver is up there too. On the bearish side, we have the Australian dollar and euro pound. So what you'll notice is there's not a really strong preference on gold. It is, of course, something that we track within the software, but you'll see that gold is getting a neutral reading or +4. It's kind of close to a bullish reading, which is 5 or greater, but we're not quite there. Not to mention, even if the Edge Finder had a bullish rating on gold right now, there's not any way I can do any trades up here. The thing is too overbought, but also in a roaring upward trend. So I wouldn't short it and I wouldn't buy it. So the only thing I can do here is to wait for pullbacks, which are pretty much untouchable for quite some time. You can see that the 38.2% retracement, the first kind of major level that I could even argue might be a buying the dip opportunity, would be around 38.50. That's hundreds of dollars an ounce away. So for those who are already in gold, congratulations, welcome to the never-ending upward rally. I do own some physical precious metals and some in my other portfolios that are just long-term holds, but I'm not trading them actively at this time. They just look like monsters to the upside, and again, congrats to any precious metals bulls. I think a mistake that a lot of traders will make right now is believe that the only thing they should be trading is gold, and they love trading gold, and that's all they do, and that can actually get you in a lot of trouble during a time like this, where if there's nothing to do and every day you're just met with there's no pullbacks, you're more likely to make some silly mistakes, like trying to fight an upward trend like this, like the many traders who have tried to call the top. In my comment section over the last few months, they've easily blown up accounts or had really tough times with this. And I don't wish that on anybody. It's just the reality of trading. A lot of people believe they know where the top of gold is, so they put on huge bets, and the market humbles them. And it's humbled me. It's humbled anybody with trading experience. You think you're so right about what the market's going to do next, and the market has a great way, a very consistent way way of playing gotcha. So for now, continue to watch the melt up, sit back, put your sunglasses on, and watch this with some popcorn, but there is nothing for me to do here at these levels. Same thing with silver. You can see that it's very volatile today, pushing in both directions. Let's take a quick look at the dollar index as well, which if you've been watching my videos, you know I do have an existing long position on the dollar. I'm trading UUP to the upside, which is a bullish ETF that tracks the dollar. Looking pretty good here in terms of this position so far. If I take a look at DXY, what I am looking for in terms of the dollar is a push back up to where I think it could be headed, the 100 level, which is not too far away. If we were to get another week or two of bullishness on the dollar, we very well may go back and test the upper limits of this consolidation range that we've seen over the recent few months. In terms of specific currency pairs that I like the dollar long against, it would be the Swiss franc. So if I take a look at dollar Swiss, you can see the longer term, and I mean longer term, we're talking about 10-year plus level of support that we're sitting on. I think that we may have upside from here. This is very counter trend in the sense that, you know, we've been in this downward trend for this year. We've now consolidated. There's not really a huge sign of a bull trend here. But what I would encourage people to think about is that currencies are not like gold or like stock indices or individual stocks. Currencies tend to mean revert over very long stretches of time. And you can see what I mean by that. Essentially, we've traded in the same spot since now to 2011. It would not be out of the question that we could get a larger scale reversal and just continue to chop around in the very big monthly chart picture. Again, if you trade currencies and you trade commodities and indices the exact same way, especially with a macro perspective, I think it can be tricky because again, they just have different natures to them. Here's a monthly chart of the dollar versus the Swiss franc or the dollar index as a whole. You can see it just has gone nowhere. Compare that to the Nasdaq, which has trended up over the years, or gold, which has trended up over the years. Do they have bear markets too? Yes, of course, and the drops can be nasty. But over the longer term, they actually have some sort of directional bias. Whereas currencies, one of the reasons that they're not a huge thing of my trading activity is because they are sort of just choppy back and forth, mean reverting type instruments. And while I still love trading currencies, I just find that, again, if you're looking for momentum and trading strategies that are focused on heavy amounts of trend following stuff, I tend to prefer to go with some of the instruments that have a more natural bias towards trending up. That being said, fundamentally, I do favor the upside for the dollar index and think that we could, if we do backtest into this 50% retracement, find some buying support and continue to make a move towards 100. We'll see if I'm right. Another thing I have a trade on, even though it went from bullish down to neutral, is Bitcoin. Let's take a look at that. So here's a look at Bitcoin on a weekly chart, which I think is still in a very dominant overall upward trend. On Friday, like most risk assets, we flushed to the downside, with many cryptocurrencies losing over 30% of value in a single day. But of course, the big one, Bitcoin, lost around 12% peak to trough on Friday. We've bounced back, however, since, and I decided to actually get long yesterday. Clearly, my timing was not great because we've moved lower here today, but I'm gonna stay in the trade as long as we don't break through these lows. If we do break through these lows, I will take a controlled loss on my IBIT position, which is a ETF that tracks Bitcoin. In terms of the weekly chart, again, I think we have an overall upward trend. And I think that risk on is still likely to be the narrative for the remainder of this year. If we take a look at seasonality for the S&P 500, Nasdaq, Bitcoin, etc., risk assets tend to have a strong performing period in the end of the fourth quarter each year. Now, that is not a guarantee or a certainty that that will happen, but we're just going off of history. And if you're a trader, price patterns do matter. And seasonality is a real thing. It's not a gimmick. It's not a fake, nonsensical thing. Is it to be relied upon 100%? Absolutely not. That's where traders lose everything, is they make too big of a call, too big of a position. But generally speaking, I would, with the benefit of the doubt, assume that there is a slight, this much, very slight probability more towards we are going to see a strong end of year rally rather than not see one. But of course, only time will tell. And in the last few years, this has been a really good trade for me that I've caught on to. And we'll see if I'm right again this year or if my luck will run out. And I should say it's not really luck because I'm not making a huge bet on this. It's a small risk on my trade, on my accounts. And again, I make this distinction because where most traders go wrong is actually in position sizing. I made this post on my Twitter earlier today. I said bad experiences in trading almost always revolve around position sizing being too big. Reduce your trade size and watch how quickly things improve. Because even with these ideas that I share in my videos, I'm wrong often in my trading. You don't need to be right all the time. But new traders, where they often go wrong is thinking that they do. They think they got to be right on the next trade and then one after that, and you just need to be right all the time. And that is what gets you in trouble, because if you believe you are right all the time, you are going to put on huge amounts of risk to a trade, and when that goes against you, it means you blow up accounts. Whereas great traders risk really small per trade, and a loss just feels like a little, it feels like a little flick, right? It's not going to kill you. But for traders who are sizing too big, a loss feels incredibly painful. That is the difference. And I know many of us are probably feeling like, wow, yeah, totally been there. I put on huge risk, felt the pain of doing that, felt the burn. And once you reduce size, you realize good trading is about small risk per trade, doing it over and over and over and over and over with an edge. That's how you make money in markets, not by taking big bets and speculating where the price is going to go next tomorrow. Today's video is sponsored by Vantage Markets. If you're looking for a better CFD brokerage and you're someone outside of the United States, check them out. Down below in the description, they're offering a welcome bonus to my subscribers who sign up with new accounts. They offer low trading fees, they have a copy trading platform, and like I said, they're offering a welcome bonus for a limited time for people who create a new account with them. With Vantage's platform, you can trade CFDs for pretty much anything. That's stocks, indices, cryptocurrencies, and so much more, all on a singular platform. You can also trade with them directly on TradingView.com, MetaTrader, etc. So check them out down below in the description if you're interested in getting started with Vantage. And if it would be easier, you can also just scan the QR code that you see on your screen right now to explore the welcome bonus they're offering. Thanks for watching. We'll see you back tomorrow.